Hello and welcome to our IT services webinar. And I'm joined here by Philip and Shahir. We are Aventis advisors. We're an M&A firm. And we welcome everyone who's interested to learn more about what's happening right now in IT services valuations. So valuations of IT services companies. What are the most recent trends in multiples? What's driving valuations? And how to maximize your gains from a potential investment or exit in an IT services company. We're very proud to be sharing our insights in this format for the second time. We've already had a successful webinar in SaaS valuations roughly a month ago. And we really enjoyed this process and we've received very positive feedback. So we're very happy to repeat this for a slightly different audience, but we're excited to see that some of you have joined for the second time our webinar. We find it extremely satisfying and exciting to understand and crack the numbers, what's behind the numbers, and make sense of what's going on in this space. But most importantly, we are happy to share this knowledge that we glean from the data, so that you can make better decisions. And these decisions are super important on multiple levels. These are often personal lifetime decisions about whether and when and what price to sell a business for, or decisions about investments that you're making and how best to execute them, how to time them, and how you can exit them. So I'll let Philip present our agenda for today. Let's dive in.
Hi, everyone, and welcome to our second webinar on IT services. So today we plan to cover a bit of everything, a bit of valuations and a bit of exit preparation. So we'll start with discussing where valuations for IT services firms are today and what we're seeing happening in 2025, what's the outlook. Then we'll speak a bit about what drives the difference in valuation, mostly size and geography. And at the end, a useful chapter for both founders who are looking to sell their businesses and for acquirers who are acquiring their businesses, how to prepare for the exit and maximize valuation, or for acquirers, basically how to look at the businesses and how to find the right one. So Marcin, we start with some headline numbers.
Yes, this is my favorite chart of today. It shows two lines basically. One, EV/EBITDA multiple of publicly listed companies, and the other, the same multiple, EV/EBITDA for private M&A deals. And we go back all the way to 2015 to try to understand what's going on and how valuations are changing. It looks quite volatile, but definitely relatively to some other industries, this industry is quite stable compared to, for instance, SaaS valuations. But still, we've seen quite a bit of change over the past few years. The biggest, obviously, being the COVID boom. And before that, we've seen fairly good valuations in the run-up to COVID, really, when interest rates were on the decline. So I think, the biggest driver, as in all stock market valuations, are interest rates. When they go down, interest valuations go up, and the reverse is obviously true. And we're seeing actually quite a big correlation between private M&A deals and publicly listed companies. We have a small artifact in our data. In 2020, 2023, where private deals were valued more highly than public. One thing we think happened here was that there was a slight lag between announced private M&A deals and publicly listed companies. So the deals actually took place earlier or were negotiated earlier, and then they closed only in 2023. But I think that we can agree more or less that 2022 was the peak, beginning of 2022, end of 2021, when the valuations were the highest. And now we're seeing quite a stabilization in valuations around 9-10 times EBITDA. Although we will be discussing this a bit later, that there are some downside risks that we can expect. So we can jump straight to the next slide. Why is that, Philip? What do you think, except for interest rates, what drives valuations in this space?
Similarly to what we see in software, here's the biggest driver is the revenue growth rate. Yeah, if you look at what happened over past 10 years, and especially in this big period of change, because most of the time in 2015, 18, there was an increase from 8 to 12 and then decrease, but the biggest jump was from around 7 times EBITDA here to 14, and that's fully explained by revenue growth. So during this period, of course, the digitalization of companies during COVID, everyone's investing into digital transformation, cloud, Zoom. So those companies just experienced a massive jump, and with that came the valuation increase. So I think many investors thought that's going to continue, and the revenue growth will continue to be at this elevated level, but then it went back to around 5%, where it was before. So this was one-time event, and the valuations declined. So I think here, if you look at the macro level, at all the companies in our samples, their valuation explained by the growth rate. So the future is also depends on whether you think it's going to pick up back again or it's going to stay where it is. I think one more interesting point that we wanted to add is the EBITDA margin. So it's okay, here's the growth rate, but what's going on with the margin? And the margin has been remarkably stable, growing only a couple percentage points over the last 10 years. So it is indeed revenue growth, which explains most of the valuation here. And I think important to note that that's EBITDA margin. So how many dollars of value you pay for $1 of EBITDA, and it doesn't matter that much what your margin is. So if $1 of EBITDA costs $9, whether you're 10%, 15%, it's
But still, the driver for valuation is EBITDA, so we should not neglect it. Growth is important, but ultimately, and what we're seeing in our practice is that IT services companies ultimately they will be valued off of their EBITDA rather than revenue. I mean, the ones, for instance, cloud services companies that we're seeing marketed every now and then, that try to get or derive their price from revenue and revenue growth, we haven't seen these deals close. So for the time being, I mean, there's no coming back, I think, to the COVID years. For in our practice, businesses that have little or no EBITDA, they are very hard to sell.
So moving on to 2025 outlook here. Here we have a couple of data points on where we at right now in terms of growth and what different people expect, including us. So before we move to bull and bear case from Aventis, and here with the dashed line is what analysts, stock market analysts expect to happen with revenue growth. So quite a typical situation. The next quarter is not going to be so good, but then eventually it's going to go up back to around 8%. And same with Gartner. So their forecast for IT services, 9% revenue growth this year. Last year, they forecasted around 8.7. It turned out at around 5.5. So take this with a grain of salt as well. So Marcin, if you had to make a bearish case, what would you say?
Yes, I am inclined to be bearish in this market environment, even though we're seeing an uptick or projected growth. I think there are a ton of macro risks that cause investors to be more cautious when acquiring businesses or investing in publicly listed companies, which poses a downside risk on valuations. And I think also a lot of companies that are struggling are coming to market, and the market has to cleanse itself of these companies that are not performing very well. And these valuations will happen, these deals will happen at lower valuations. So I think we'll go through an intermittent period of lower valuations to eventually emerge at the higher multiples. But Philip, I know you were a bit more bullish than me. So how would you argue that?
I mean, to argue bullish case, I'd focus on a couple of points. First, about the cycles, and the next one is AI. So first one is the cycles. I think what we saw over the past couple of years is a bit of downsizing of IT services companies. So a lot of firms hired aggressively during the COVID period, when there was a lot of demand. So when this demand declined, they were left with a big bench and with people who are not staffed on the actual projects. So they had to go through this period of optimizing, some cuts of staff, some downsizing. And now it's more than 2 years since that time. So I think now everyone who started this already downsized, and they start this year from a much better position. I think the labor market is improved. So if you want to hire people, if you have big jumps in demand, it's a bit easier. But more importantly for this industry, I think if you want to make a bullish case, you have to think about AI, and that it's a benefit really on cost side and revenue side. So AI transformation is coming up. A lot of companies will need to implement this in their processes. We have custom GPTs, chatbots, all kinds of APIs, and optimization of business processes. I think there's a big market for this. We haven't seen this so far, but this should be coming. And the other part is the cost side, with development being so much faster. I think it's just the potential for improvements in margin. So yeah, I think the starting position is better. And if this AI revenue and savings materialize, then the current multiples for Viat, I think may go a bit higher, maybe back to they were in 2018, like around 12 times.
I surely hope that happens.
Okay, so moving on to size and geography effects of valuation. I think we were also interested in how does valuation differ by geography, and here we see a couple of interesting points. So Martin, what did you want to emphasize here?
Yes, it always impresses me how valuations of companies in the same space differ across geographies. And it's very hard to explain rationally, but it is what it is. Over the past 10 years, we've seen quite a bit of differentiation in different markets, and they all took different trajectories. I think what stands out in this chart is India, which is a massive outsourcing destination for IT services, but also happens to be in quite a large stock market bubble. And we're seeing that in the stock market, in the public valuations, which are more than double of what even today of European or rest of the world average, and almost double of North American valuations, which have, by the way, come down and are beginning to match their European peers. So that's another interesting trend we're noticing. But in any case, and we can maybe transition to also private valuation. We're seeing a huge differentiation in valuations, which creates a big opportunity for arbitrage. So buying an asset in one geography and consolidating and marketing it to investors in another geography. In particular with India, with the close to 19 times EV/EBITDA multiple in the stock market, and we're seeing the same also in private deals, that there's a premium for Indian companies. It's a tremendous, tremendous opportunity to create value through betting on different markets and buying in one market and selling in another market. So it's something we try in our day-to-day practice to leverage also. So to bridge people in different geographies so that eventually they build win-win deals and create value for the promoters. So this is a super interesting trend. I think this will continue in one form or another. Although what we're seeing is that the lines seem to be converging. So it would be interesting to see what happens in the next few years and if the convergence continues. But for the time being, I mean, the differences are really huge.
And I
So
think it's interesting to note that the difference in growth rate is not that big. Yeah, 6.6% versus Europe's 4.8, North America 0.5, but that, I mean, this wouldn't account for double the valuation multiple. So I think there is some way to go down for listed companies' valuations, especially for the biggest ones, which are growing very modestly.
speaking of size, Philip, let's jump to how size affects valuations.
Yeah, I think it's important to note the effect of size and valuation multiples, because what we saw before are numbers for relatively big companies. So if you think about valuations of 10 to 12 times EBITDA, those are the biggest players that are in our sample. And for smaller IT services companies, the valuations are often not there. So many of the founders who own, operate smaller businesses may not see those numbers in their offers. And we're here to explain a bit why and how that differs by size. So what we've been observing for a long time, both in the data and in our practice on how bidders actually value the companies, as the gap is quite significant. So here we compare EV/EBITDA multiple relative to the largest deals of 500 million plus, which is where our listed companies are, that the discount can be up to 54%. So for the smallest deals below $5 million, it's 6 times EBITDA multiple, $5 to $20 million, it's 8 times EBITDA multiple, and then 10 and slowly going above. And this is explained usually by a couple of factors. First, it's just less risk to buy a bigger company. Smaller companies sometimes have customer concentration or founder dependency or some individual issues. For a bigger company, it's much more stable. And then the access to capital, what we're seeing is that in the smaller ticket size, it's just not many buyers sometimes, while if you're reaching for 20-50 million dollar deal size, you have private equity funds, strategic investor, everyone competing for the deal, just driving up the multiple, and their cost of capital is lower. So it's a combination of factors, and when you analyze your exit opportunity, so the offer you have on the table, I think it's important to keep in mind that size is one of the biggest factors. And Marcin, you wanted to add also something about roll-ups. and how's that
Yeah.
used as facts?
We're seeing more and more roll-ups in the IT services space. And it's a great value creation tool because as you move from a deal size of around 5 or less than 5 million to 20, the multiple basically doubles. So it makes a ton of sense if you have 4 companies that have 5 million revenue to put them together. Obviously, not haphazardly patch them up, but manage a good integration. But the payout is immense from doing that. So obviously, the easiest, if you can grow, is to grow. But if on your own you're not able to grow your IT services company, then it makes sense to consider either merging with a peer or buying up a handful in order to make this leap forward and reap the benefits of the expansion in the multiple. So it's a great financial strategy to leverage the understanding of how valuations work. A ton of people have made smaller or bigger fortunes by pursuing these strategies. And by the way, we did not mention that we encourage all the participants to ask questions. We'll have a few minutes we're setting aside at the end to answer them. So if there's anything that we've run over too quickly, then feel free to type them up in the chat box, and we will address these questions at the end of the webinar. So maybe a quick recap before we move on to the next section. We've covered so far the trends in valuations, what's been happening over the past 10 years, and how EBITDA margin affect valuations, and also how size and how the geographies affect how IT services companies are valued. So if you would like us to expand on any of these, then feel free to shoot us a question.
Okay, so in the meantime, we wanted to cover at the end some preparation for exit topics and maximizing value of your business. And how we think about this is kind of a bit of different time horizons, long term, medium term, short term. And to start with, I wanted to touch on the long term view and basically the AI race, which is the talk of the town right now, and everyone's discussing it. And I think that in IT services businesses, there'll be some companies that are going to need to transform their business model and their company, and some companies which will be more resilient to those changes. And when I think about AI and what it does is that it lowers cost of development. So on the one hand, many IT services companies' business models are based on time and material, so they're billing hours of developers. So the first thought is, okay, you're going to bill less hours, so the revenue will decline. But on the other hand, as we see with AI and other technologies, maybe you'll just do 10 times more software. And while the software is still value added in other business processes, it's just going to be more software developed with the same number of developers and time build. But I think still, like, this question is not certain, and we're no experts on AI and IT services. I still think there will be some companies that are more likely that they need to transform, and some companies that are more resilient. And when I think about this, I think about the training data for AI models. So the more data AI has, which is similar to what you're doing, the more likely you'll need to transform. So something like a restaurant app, AI, or e-commerce website, AI probably has a lot of code on that from GitHub and all different restaurants apps. So it can generate a good quality product. On the other hand, if someone is doing a back office compliance tool for a bank, likely AI doesn't have access to that, and that product is much more complicated. So those companies will be more resilient. So for me, most likely candidates that need to transform the business are companies that do products like MVPs, proof of concepts for startups. So something which is rather simple, some plain vanilla managed service providers, help desk, first line support. I'm sure AI is trained on hundreds of thousands of queries, and those are the same across the globe. QA testing, web development, SEO. So everything which is rather standard and can be generated, while stuff which is customized for vertical for particular clients, this will be much more resilient. So I think if you're thinking of an exit over long term, so one of the questions you need to ask yourself is what's going to happen with your business over the long term in line of AI, and will it replace your people?
But there is no doubt that all companies in IT services will need to transform. So I think the pace of change will accelerate in what has been already a mature industry, fairly mature and fairly stable. I think we will see much more disruption nowadays in the next few years than we've been used to in the last few years. So I think it will be very interesting to observe this transformation.
This is like a high level strategic view. If you're preparing for a company sale over a medium term, I think that the kind of things that buyers look there are the same, which is recurring revenue. So everyone likes long-term service contracts, a company which does only short-term projects, limited visibility over the next 1 or 2 years. It's difficult to sell. That's what we're seeing from the market. Then client diversification is also one of the first questions that anyone will ask you. So if you have a client which is 30, 40, 50%, it's a lot of times a deal breaker because it's just too high a risk that the buyer cannot take, or you're going to get a big discount on multiple, or an earn-out structure, or something that the buyer will try to mitigate this risk for him. So these are two factors that are very important in any IT services company sale. And then the other two are enterprise client base, vertical specialization, something that everyone likes. So enterprise clients have better revenue stability, more resilience in downturn, while what we're seeing from the market that if your customers are startups or the work depends on their funding cycle, then it's much more difficult to sell a company like this, or the valuation is lower. While if you focus at any particular vertical, and some popular ones, healthcare, life sciences, insurance, banking, then people look at that very favorably, because you just can win deals in this vertical easier with all the knowledge, all the know-how in that industry that is accumulated. So
this is also an answer to AI. What we're seeing is you cannot just work in the basement, never see the client, and just code, because this becomes commodity. You have to be facing your clients and have a human-to-human connection. And this is much easier if you bring to the table vertical expertise rather than just technical expertise. So we're seeing businesses evolve in this direction, and I think this is the best way to protect yourself from any disruption that comes from AI, to be more humane.
Yeah, so to be more humane and over medium term, just focus on the stability of the business. And at the end, we have a couple of short-term things which we recommend the sellers do if they're thinking about selling business in the next couple of months or in the next year. So first is implement some quick wins. So this downsizing that we talked about. So if it's still not done in your company, I think delaying this is not ideal, and we recommend that you benefit from some of the margin uplifts that is possible. And right sizing is just part of IT services business, and I think the buyers understand that you may have some changes in staff numbers over time, but what they don't want is that you constantly have excess capacity and people on the bench, and without regard to the market or projects coming in, the staff numbers are the same, so you just have a lot of overhead expenses. And I think nowadays it's much easier because the labor market normalized. So it's difficult to hire people from the market, so companies were slow to optimize. Now I think it's different. So implement some quick wins to have some of the value for yourself, some of the uplift in EBITDA. And then the other two point about knowing your past and future are more about signaling to the potential buyers that the company is well managed, well run, you know your numbers, you have a forecast, and you manage it based on the data. So what we recommend founders and owners is to track some key KPIs. What's the average build rate? What percentage of the people you have on the bench? What's your gross margin? Those are some of the first questions that anyone will ask you. And given this historical clarity, just shows that the company is well managed and boosts buyer confidence, and the information exchange is shorter. And the other important point that we also highly recommend is to work with forecasts and have at least 12 months revenue forecast for your business. Ideally based on some contracted clients plus pipeline analysis, which is based on win rate, cycle time. So anything which is backed by the data just brings confidence to the buyers that you know what you're doing, you know where the business is going, and if anything goes bad, you'll see it in advance. So visibility, realism projections, and I think a company can get more offers, better offers. So knowing your metrics, knowing where the business is going, and having numbers to back it up, I think it's super important if you're thinking about exit in the short term.
If I'm a founder, when should I start thinking about it?
I think 6 to 12 months is the best to spend some time on quick wins and have the results from this, and then have some time to implement the operational metrics tracking, forecasting together with your team. This is done usually with some people from finance department, and it's best when it's not done on an ad hoc basis one time, but then you start doing it on a monthly basis. So as the deal progresses, you report what your monthly numbers are, how your forecast changes, and kind of gives this confidence to the buyers that they're protected from downsides. They know what they're buying, what the revenue will be, what the profit will be.
And can this be done in parallel to the sale process, or it's better to think about it earlier on and only enter when you're done, only enter sale discussions?
I think you can start a bit earlier, and in the latter part it can overlap. Yeah, but best to start, and then when someone comes to you, you already have this in place.
Okay, so I think this section we can wrap and move on to the summary of what we've been discussing so far. So the first is valuations. And I think there are reasons to believe that the markets will go up and reasons to believe the market will go down. Markets always seek equilibrium in one way or the other. I think we agree that there still might be quite a bit of volatility, although I am cautiously optimistic that we're heading for a more stable environment. And I am even more optimistic that that growth in IT services will be picking up. I think during COVID, a lot of R&D spend was front-loaded, was done ahead of time. And I think that disrupted a bit the cycle in this industry. That's why we had also a bigger downturn than what would normally happen. So I would be hopeful for growth to come back and valuation rebound. It's important for any IT services founder to focus on EBITDA. This is hard to stress enough. Although revenue growth is still important. But still, I mean, in our practice, we're seeing that EBITDA is king and is the main driver of valuation. And this can be optimized most of the time in the short run. So it's good to think of that ahead of time and not to be afraid of making sometimes difficult decisions, because ultimately the gains in valuation are important. The market is cyclical and driven, and market valuation, the average market valuation is, as we say here, rising tide lifts all boats, driven by what's happening in the environment. So when the times are good, a lot of acquirers open up to growth or inorganic growth opportunities, and even poor performing companies get an uptick in valuation. So if you can, better to time your exit for periods of quicker market, I think, service market growth. And also important to remember that different geographies, different valuations, so there are opportunities to create some value by combining businesses in different geographies to maximize valuation. And last but not least, you have to think strategically, especially in the context of AI, about how you manage your business, how to grow your business. There are safe and tested and proven strategies how to build sustainable value by building niche expertise, by focusing on growing recurring revenue, by diversifying your customer base, not letting one customer take up too much of your capacity, and typical operational best practice. But AI is going to make changes in the IT services space, so you have to keep your eyes on the ball and make sure it doesn't that the wave doesn't sweep you, and you are the one who's the winner of the AI revolution and not the one that's left behind.
Yeah, I think to that last point, I wanted to add that this industry has been undergoing through transformation for a long time. We've seen during COVID, there was a big uptick in demand and new technologies implemented. There was transition to the cloud. So change is part of the business. And I hope that, as you said, everyone keeps eyes on the ball and just go through this successfully for their company. It's just one more new technology, and many people in the industry have great experience with managing change, and they see that every year something new shows up, and AI is one of those things.
So in the meantime, a bunch of questions popped up. We will be sharing a recording from this webinar, and the presentation will be available for downloading also. So you can read it and share it at your own pace. We're also available if you have any follow-up questions offline, so feel free to shoot us an email and we'll be happy to answer this. How much time have we got, Philip? Okay, so let's take one or two questions that also came in, and then we can wrap. So the first question I see: how the valuation multiples differ within different types of IT services business? I think that's a very good question, because we're seeing different market segments being valued differently. What's your take on that, Philip?
Yeah, I think it's very fair that different IT services segments are valued differently. I think what's valued higher is...
I think Philip froze.
So I think what's valued higher is segments where you have more enterprise customers, more recurring revenue, kind of bigger projects. So something, for example, as cloud transformation consulting for big companies, that's what will be valued higher, while something more as staff augmentation or staff in IT recruitment is usually valued lower, just because of the nature of the clients and the service provided. So it's very typical that there is quite a big gap between different types of services.
We got another question about SaaS companies. Do we use ARR multiples? Yes, we do. We encourage you to take a look at our website because we have a previous webinar also available from a month ago where we discuss at length SaaS valuation multiples. I think we can take one more question, Philip, which is quite interesting. Do we see any difference in valuations between strategic and financial buy and build platforms? What's your take on that?
I think strategic acquirers can offer slightly higher valuation multiples typically, but the probability of closing with a strategic company is a bit smaller. So you really need to fill in some particular gap for a strategic buyer. So a big company which wants to add Salesforce consulting or ServiceNow implementation, for example. And if your company is in that niche and if it closes some gap, then you can see strategic buyer pay more. Typically, financial buyers will be interested in more companies just because they are very often agnostic and they're building some diversified platform and do it for this multiple arbitrage that we said, but the valuation will be a bit lower.
I see new questions have come in. Maybe let's tackle them also. US-based IT services providers, are they still open for business? Are they still doing cross-border M&A? What does the data show, especially after tariff implementation? My take is they're still open for business, even more so, actually, because this is one of the few areas that are not affected by tariffs. So the new regulatory environment is more favorable towards M&A in the US. So long as the global governments don't get into the fight about tariffs on IT services, I think we're good. And I think we'll continue to see a lot of cross-border.
And one more point here, I think US-based data services companies still benefit from outsourcing. So they have to acquire abroad or build their own delivery centers. From what we saw in our work and research, there are not many pure US-based companies left just because it's so expensive to have developers in the US. So they will continue to invest abroad.
We have another interesting question. So there is a discount on EBITDA valuation based on size. Is there a premium for revenue growth, high EBITDA margin, or other factors? Yeah, let's take it one by one. Revenue growth. It would have to be very high revenue growth rate, I'd say, in order to expect a high premium. When we're seeing businesses that have revenue growth in 1 year, but because of cyclicality, a decline next year. So it's not a strong indication, revenue growth of, especially for a smaller business, of higher value and higher resiliency, unless maybe it's in the neighborhood of 50%. Then it's substantial enough to drive even maybe a 50% premium to EBITDA multiple. But you have to be in that territory, and it has to be sustainable growth. And IT service businesses are difficult to scale, so it's rare to see sustainable growth of that magnitude. So that's why it can be quite valuable, but it has to be sustainable. Of course, I mean, higher EBITDA implies higher growth. Other factors, I think there are pockets, let's say, of activity where there are premium valuations. So, for instance, what's hot today? I mean, anything AI. If you focus on AI implementation, it's you can expect a premium. Cloud transformation,
data engineering partners, Databricks and Snowflake, ServiceNow. I think is also quite hot. We see a lot of acquirers interested in that segment.
So if you're attached to a hot vendor or a hot space in the cyber also, something that is growing has favorable tailwinds, you can expect a premium to the baseline multiple that we've shown. So with this, I think we can wrap. It's been a pleasure to share our findings and what we've researched in this space and our experiences with our clients. If there's anything you'd like to learn, feel free to contact us by email, by contact form. We'll be happy to have a call and discuss your particular transaction. So as I mentioned, the recording will be available. We'll distribute it to you. Thank you so much for your time.
Thanks everyone for joining, and have a good rest of your day. Bye.